the sector. Joining us now, Renaissance Macro Research Chairman Jeff deGraaf. Jeff, great to see you. Thanks so much for joining us. What is your take on the banks this year? They kind of had a great early surge, and you could understand why based on the fundamental outlook, but have chopped up and down within a range since then.
Yeah, they have. And look, they've got a very high sensitivity to 10-year yields and frankly short-term rates as well. But as these rates have moved higher, they've been big beneficiaries of them, or at least perceived beneficiaries of them in the marketplace, and that historically has been good news. Yeah, I think it's interesting. The banks have really taken on sort of a new dynamic since the great financial crisis, 13 plus years ago here. And that correlation's been a lot higher between banks and the 10-year yield. So, I think that's really got a lot to do with it. As these rates have moved up, it's been good for the banks. And, the relative performance would suggest right in line with energy, frankly, that those two areas of the market are still strong. But we're fading the banks here a little bit more tactically just because of what we're seeing in the bond market.
What do you mean? What changes this pattern?
Well, it's certainly not a momentum call. It's not a trend call from us. But when we look at the sentiment that's developed in the bond market, and it's easy to see. It's, frankly, we feel the same way, which is there aren't many good reasons to be bullish on bonds. In other words, you'd be expecting higher yields. And that certainly feels like the right call. But when you can't see the other side of the narrative, that to us is always a bit of a warning sign. And, one of the ways that we measure that is through a service called Consensus Inc. that measures how many bulls there are in various commodities. And there's a relatively low level of bulls in the bond market, which means that most people are expecting higher yields. And it's gotten to the point where we've looked at this historically and said, hey, this is an area that we want to be cautious around being too bearish on bonds or looking, too much for higher rates. So even though the charts would suggest that that's the case, it's a very crowded trade. And if that ends up proving to be true, then obviously it's going to have ramifications for the banking sector. We are expecting, continued flattening of this curve. And I just think we're going to get into this late first quarter, second half of the year, and it's going to be a little bit more troublesome for the banks to continue this trajectory that they've had here over the last 18 months or so.
Jeff, what about the broader indices? If we talk about the S&P 500, more likely to retest its 2022 highs or lows next?
It's a great question, and it's almost a flip of a coin. I actually think because of the circumstance that we're in terms of the fiscal position, the monetary position that is, and what we're seeing out of momentum, that we probably have at least a retest of the lows, if not a deeper decline. We had a very good oversold condition a couple weeks ago. That prompted us to turn tactically bullish. The problem is, off of that low, we really haven't seen anything that's impressed us. And so within that it says to us that there's more work to do. I'd say the good news about the overall market is the sentiment conditions are still fairly bearish. They're not as bearish as they were around COVID or even the lows back in 2018, but they're elevated enough. There's enough bears to suggest that, it's probably not a vicious swoon. And frankly, I like to see these geopolitical events take place and the market be able to absorb them relatively well, because it says there's something broader there. But I think it's going to be tough sledding for the S&P, and obviously it's going to be tougher sledding for the Nasdaq, as we've seen more of a top formation and distribution. So I think we've got another shot at the lows to set that up, and then probably a lengthy consolidation, and then start to break out again after we get some shift in the monetary regime.
So you think it's going to be tougher sledding for the Nasdaq, even though it's gotten hit harder? It's down 15% from the highs, and it sounds like what you're saying is you may think that rates are peaking out here because it's just a too crowded trade. Wouldn't that help the Nasdaq?
Well, you'd think so. I think you've done enough damage to the Nasdaq here that it's going to be, there's an old saying, you never stand in the same river twice, right? And I think that's the same thing, that even though rates might come down, sometime in the second quarter, maybe the late first quarter here, I think there's been enough damage done that we're going to see this be a little too easy to things just rotate back into the Nasdaq. So I'm still skeptical there. I think we've put in a pretty significant top in terms of the amount of dollars that were really attracted by these ultra low rates, and a lot of that capital has been destroyed, but I don't think all of it. And I think there's just still more weakness to come there. You need to get to the apathy part and to the indifference part for the Nasdaq, and I still think there's enough sort of intrigue with some of these names that unfortunately that needs to be extinguished before we make a low.
Jeff deGraaf, thanks so much for joining us. Good to see you.